The reason why I love dumping cash inside of the insurance reserve is it serves three purposes. One, my money is beating inflation. It beats inflation. My money's making 4 to 8%. I got a death benefit that's up to 8 to 10 times its value in the marketplace. So 8 to 10 times its value in the marketplace. That means if I pass away, my family would get 8 to 10 times of worth of what I put in back to them in death benefit as a thank you. So I got my legacy secured. I also have where my money is in an insurance reserve making 4 to 8%. And then if I ever wanted to access that money, I can borrow against it. What borrowing against it means, I leverage the money in my account and I use the insurance company's money while my money is still making 4 to 8%. Number one thing that we fail to understand when it comes to money is that your money as itself, debt cash, loses value every single day. And because of the stimulus checks, we're talking about 4 to 8% hyperinflation that's about to happen to us because of all the money that's been dumped into the marketplace. So how do they make money? They make money by, when you get interest-bearing accounts, they make money off monthly fees. They make money off of overdraft charges. They make money off of ATM charges. They make money off of merchant charges. You have to charge your card somewhere. That charging of the card is communication between one bank to another bank. There is a merchant fee that's in the process of that. So banks are in the money game.
A lot of us believe that money is an asset. Cash is not an asset. It is a debt. It says this on our paper. It is a debt. And what are debts? Liabilities. Debts are liabilities. So a lot of us, we bank our entire life taking liabilities and then buying liabilities.
The ABS Tribe experience starts now.
Well, when you start a policy, it is a contractual agreement between you and the insurance carrier. So whatever you start the policy doing, you have to keep doing that. You cannot just go put $30,000 into a policy that you started off doing $5,000 a year. It doesn't work like that because there's a contractual build out of that policy which keeps you subjective or subject to the actual contract. So when you begin to make more money, that's how you end up opening more policies and getting more policies. No different than a bank. When one bank is doing extremely well, wouldn't it make sense for that bank to go find another location, open up again with overflow, and continue to make money? That's how your business is monopolized. So when it comes to me writing policies or me opening up all these policies and banks that I call them banks that I have, it's because I make more money. And what I started with, or, my first policy I started was like $2,000 a year. Well, clearly I can't put $100,000 into a $2,000 a year annual policy. So there has to be some type of buildup of different policies when you make more money. That's why I have multiple policies, and it spreads your risk. So if you have in insurance policies, they have something called critical illness. When you tap into your critical illness, you're forfeiting all of the extra death benefit that comes in that policy. So if I have 13 policies and I get sick or critically ill, I can just tap into 2 of the policies and get that money out while my family still has 11 policies working on behalf of us. So you got to understand the importance of mitigating your risk.